Today's episode is about reducing the income taxes involved with the sale of a farming operation. Hurry back and find out how. Hi, I'm Norman A. Hood, financial advisor and host of the Exit Plan Show. I interview America's top advisors to help business owners enjoy more freedom, grow companies faster, and retire someday on their own terms. Today's guest is Daryl Dunneman. He's an agricultural financial consultant and accountant with Bonnet and Dunneman, LLC, certified public accountants and consultants. Bonnet and Dunneman serve clients in 18 states and have offices in Bushnell, Illinois and Havana, Illinois. Daryl's a 1975 graduate of the University of Illinois and a nationally recognized expert in the areas of agricultural financial analysis, business succession planning, and agricultural estate and income tax management. He's the editor of the Farm and Ranch Tax Letter, a monthly agricultural tax publication, and writes a regular tax management column for Farm Journal. Daryl's contributed to columns in practically every major farm publication in the United States and is a regular speaker at a number of national agricultural business education venues. 85% of Bonnet and Dunneman's business is in agriculture. Welcome to the show, Daryl.
Morning, Norm. Glad to be here.
We're going to talk today about income tax and farm transfers. We're going to talk about just the sale process in general, using installment sales to reduce taxes, and in how you handle equipment and breeding stock in a farm transfer. So let's get started.
Great. When we talk about income tax planning for a retirement or a sale, individuals have to remember, especially if you're an individual proprietor, that there are two things that we look at. One is often forgotten, and that's not only that we have to deal with income tax, and certain assets will be at lower tax values through a capital gains tax, again, if you're an individual, but we also have to deal with self-employment tax. And at the last year or two of a farmer's working lifetime, when he starts moving from most of our farmers don't retire, and a lot of them, they're kind of like they retire when we bury them. Mm-hmm. But if they do, they generally go through some type of process where they cease being an active farm operation and end up being a landlord. And the same thing can happen whether you're a farm business or a non-farm business. You own the local hardware store. You may sell the operating portion of that store. You may retain the building as a source of income down the road. But you don't want to be involved in the day-to-day operations like you were once you were in business. So remember that self-employment tax problem, and we'll come back to it and address it a little bit. When we get into a sale, oftentimes we need to sit down and plan. My recommendation is that you start the process about 3 years before you really go ahead and execute the sale. And what you want to do then is to plan the sale of inventory, because that's going to be your hottest item, your most expensive item, because that covers both income tax and self-employment tax. Now, what a lot of people do, they have this theory that they want to stretch their grain over 2 or 3 years. That may not be the best opportunity, because you've got to remember that we do still have a ceiling on the portion of self-employment tax, the actual retirement portion. And the Social Security tax, as we know it, self-employment tax, is made up of two parts. There's actually the retirement benefit, which if you're an employee is about 6.2% or 12.4% if you're a sole proprietor, because you have to pay both sides of it. Then there's the Medicare portion. And there still is a limit on the retirement portion up to, and it changes annually, or it has in some years, but somewhere north of $100,000, you quit paying that base retirement plan. Now you have to pay the 1.45, or it's doubled if you're self-employed, Medicare tax for time immemorial. Whatever your earnings are, you have to pay for it. And so what people believe that they need to do is to spread that grain, for example, or cattle or hogs over a 3-year period to try to minimize that top bracket. Well, really, when you get up into the top bracket above 28, then we got 32, there are not that many jumps above that. But there is that large Social Security or self-employment tax obligation. So we find most of the time you're better off burning all your inventory in 1 year. You pay one limit. And so you're getting a lot of that grain or ordinary operating assets inventory assets through without then paying the higher self-employment tax. And you would pay maybe the full self-employment tax over 3 years. So break down, get rid of your inventory in 1 year. What about the equipment or livestock? That basically we would like to also bundle in 1 year. Now that you could, if you had livestock and equipment, you might decide to sell the livestock in 1 year, the equipment in another. Again, auction, we bring it to a fruition. Some people like to piece out their equipment, but remember, if you're going to have an auction, you want to have most of the major pieces of equipment that are found on auctions. You want a combine, you want a planter, you want a major tractor. That draws individuals to your auction. So look at that in the timing, sit down, and then measure it out. Now, one thing we sometimes do that takes the sting off of that last year or two, you're going to have a lot of cash coming in. A lot of time, maybe some of the cash may go to real estate debt retirement or retirement of equipment, but yet you're likely going to have a lot of money around. There's something else that we do in the last year or two is set up a retirement plan, like a 401k plan. 401k plan is kind of neat because it allows you to put voluntarily, depending again on your age, over $22,000 voluntarily in, and then a percentage of what your earnings are above that. And basically, if you're over, age 55, you can get over $50,000 that you can stick in a retirement plan. Now, the retirement plan will stop the income tax. However, it does not stop self-employment tax. And you need self-employment income or wages to be able to place money into that retirement plan. And a lot of times in the last year or two, a farmer may not have an employee, because the other caution you have to use, what's good for the goose is good for the gander. If you've got a full-time employee over 1,000 hours and worked with you over a couple, 3 years, you've got to include that employee in your retirement plan. Now, he's probably not going to put the full voluntary that you're going to put in, but still, in the end, to hit the maximum, you're going to have to match the same percentage of that profit in him. And so we can put a whole lot of money away in those last couple years. You're going to be old enough, you can start drawing it out the next year if you want. But that's one key to doing it. Let's then switch gear a little bit, and let's talk then about, so we've got the equipment, we've got livestock. Now, if you got breeding livestock, and so you're selling this livestock to your son or to a neighbor, you're allowed to sell those assets, again, raised, and I'll emphasize raised breeding stock, on an installment basis, which means we sit down, calculate the gain, and then over the years that you're doing this installment, and so if it's a cattle herd, it might be 5 years. If it's hogs or sheep or something like that, it might be quicker, it might be a 3 year. But we're allowed to spread the gain. We calculate the gain, and then what is the gain? That's spread over as we receive the cash income, and of course that's capital gains. That's some of the best, maximum of 15% that you're going to lose under the current code. Again, we got to be careful, something we could spend a lot of time on. Alternative minimum tax, we generally don't see that in a liquidation of breeding livestock, but we could. Equipment is a much different deal. Until about 1987, it was fairly simple. It was almost comparable to what we did with breeding livestock. However, around 1987, the law changed slightly, and basically, you can do an installment contract of equipment. However, in the first year of that sale, you've got to pay back all the depreciation that's been taken. And so you'd end up with more tax than the money you get. And so be aware of that. Yes, there is an installment sale of equipment, but the tax is not based on an installment. And again, if you're doing this for family members, remember, do you really need the income? Because you can avoid the income tax and capital gains or self-employment by making gifts to the next generation, making sure, of course, that you observe the rules and regulations that are in place at the time.
Okay, well, I think we covered that pretty well. Thanks again to Daryl Dunneman of Bonnet and Dunneman CPA and consultants in Bushnell, Havana, Illinois. Appreciate all your help. If you want more information about Bonnet and Dunneman, you can visit our website. Check out the show notes in this episode, and we hope to see you all back again later. Thank you.